The fastest way to empty a bank was never a robbery. It was a rumor. A clerk hammers a notice to a locked London door. A stone cracks a bank window while police hold back a crowd clutching passbooks. One of these lines outside a bank changed what's printed on every bank door in America. Nailed to the door. In 1866, Overend Gurney & Company was London's largest discount house, buying merchants' short-term IOAs below face value and collecting in full later. For years, its partners had quietly buried loans that would never be repaid. So when the firm sold shares to the public in 1865 to raise fresh cash, new buyers had no way of knowing they were stepping into a £5 million hole inside a £20 million balance sheet, roughly £600 million missing at today's prices. Picture a shopkeeper with 10 unpaid bills and cash for only 8. Changing the sign over the door doesn't make the other 2 vanish. On the 9th of May, the partners asked the Bank of England for a loan. It said no. By 3:30 the next afternoon, a clerk hammered a short notice to the firm's door. Payments suspended. One new shareholder, who had bought in only months earlier, was later ordered by a court to help cover the firm's debts on top of his lost investment. Lombard Street filled within the hour with clerks and cab drivers chasing cash from banks that owed them nothing. England's central bank spent its own reserves that week, propping up every solvent firm nearby. A rescue so consequential, it became the template for how central banks handle a panic ever since. Turning the firm into a public company was meant to protect its partners. It only spread the ruin to strangers who had never met them. 6 of 7 ruined. A bank collapse is supposed to hurt the bank. In Scotland in 1878, it hurt the people who had only ever owned a piece of paper promising them a share of its profits. On the 1st of October, the City of Glasgow Bank closed its doors for good. For years, its directors had hidden losses from speculative loans on American railroads and Australian land, filing reports that showed healthy dividends where none existed. So shareholders kept buying in and depositors kept trusting the bank's name on the high street. Newspapers that October put the shortfall near £10 million, close to £1 billion today. Scottish banks at the time gave shareholders unlimited liability. Owning stock wasn't like buying a lottery ticket with a fixed cost. It was more like co-signing a loan with no ceiling. 1,200 people were on the bank's share register. 6 out of every 7 of them were ruined outright, ordered to pay debts many times larger than what they had invested, while every depositor, remarkably, got their money back in full. Director Robert Stronach was convicted of fabricating the bank's accounts and sentenced to 18 months in prison, a term that struck many observers as lighter than the damage he had caused. The people who expected a share of the bank's profits discovered, too late, that its losses belonged to them as well. The Grille comes down. A failed attempt by speculators Augustus Hines and Charles Morse to corner the market in copper stock triggered a chain of bank runs across New York in October 1907. Knickerbocker Trust Company became a target once word spread that its president, Charles Barney, was tied to Morse through business dealings. Trust companies competed with regular banks for deposits, but held far less cash on hand to cover withdrawals, often close to 5 cents on the dollar against roughly 25 cents at national banks, like a coat check counter promising 100 claim tickets but keeping only 5 coats ready to hand back at once. On October 21st, Knickerbocker's own board forced Barney out, and the clearinghouse that other banks relied on to settle payments withdrew its support. The next morning, a crowd in autumn coats and bowler hats packed the marble lobby, and tellers kept paying out until the counter grills came down at 12:30. Nearly $8 million gone, worth roughly $250 million today. The suspension turned scattered runs into a citywide panic. Private bankers led by J.P. Morgan and the New York Clearinghouse organized emergency loans across the city's banks to stop the panic from spreading. That a handful of financiers, not the government, had to do the job strengthened the case for a permanent lender of last resort. 6 years later, Congress created the Federal Reserve System. Too big, too fast. Continental Illinois had grown into the 7th largest bank in America, partly by buying loan participations from smaller banks to get around limits on branching outside Illinois, including about $1 billion in energy loans bought from Oklahoma's Penn Square Bank before Penn Square itself collapsed in 1982. As those energy loans soured over the next 2 years, confidence in Continental soured with them. A government review later traced part of the May 1984 panic to a Tokyo Wire report, garbled in translation from from rumors into disclosure of failure. True or not, the run that followed was real. Corporate treasurers in Tokyo, London, and New York moved their money out by wire. 30% of the bank's funding gone in 10 days without a single customer standing in a lobby. Borrowing overnight money to fund loans that take years to repay works like financing a 30-year mortgage with a loan that must be renewed every few days. Fine while lenders keep saying yes, catastrophic the moment they don't. Comptroller of the currency Todd Conover told Congress that letting Continental fail risked a financial crisis of international scale. Regulators answered with a $4.5 billion rescue, worth roughly $14 billion today, including a $1 billion purchase of preferred stock that left the FDIC owning roughly 80% of the bank. Continental kept its doors open, only to be acquired by Bank of America a decade later. Proof that too big to fail didn't mean too big to disappear. The sticker on every door. Across the Bronx, the name Bank of United States sounded like a promise from Washington. It was a private lender, nothing more, built around immigrant families who trusted the words on the sign more than they understood its books. President Bernard Marcus spent years inflating the bank's own stock through shell companies and lending against real estate that was fast losing value, a shopkeeper writing his own reviews and pricing the shop's shares off them, until the number on paper stopped meaning anything the moment buyers asked for cash. When depositors noticed the cracks in December 1930, no rival stepped in to help a bank the city's old money bankers saw as beneath them. Lines stretched down brick sidewalks for blocks, breath fogging in the cold, one man gripping a frost-stiffened passbook while police held back a crowd that had already put a stone through a window. It became one of the largest bank failures the country had seen, and the fear it set off rolled through thousands of smaller banks over the next 3 years. Marcus himself was later convicted and sent to prison. A similar scene would appear years later in a Hollywood classic, It's a Wonderful Life. A crowd at a wooden counter, someone waving a passbook demanding cash immediately. It took a new president closing every bank in the country for a forced holiday, and a federal agency insuring deposits up to $2,500, worth about $60,000 today, before Americans stopped needing to run. That number has climbed 100-fold since, backing a small decal now glued to nearly every bank door in the country, sold as safe. Through the 1980s, Lincoln Savings and Loan in California, controlled by Charles Keating, moved far beyond ordinary home mortgages into speculative real estate and high-yield corporate bonds, the kind that pay extra interest precisely because no cautious lender will touch them. Those bonds were sold at Lincoln's own teller counters to retirees who had walked in planning to renew an ordinary certificate of deposit. A federally insured deposit and an uninsured corporate bond can sit in identical envelopes on the same counter. Only one of them is protected if the company behind it goes under. On April 14, 1989, federal regulators seized the thrift. About 20,000 investors were left holding bonds in a bankrupt parent company, many with the retirement savings of $30,000 or $40,000 they had believed were as safe as any bank account. Courts convicted Keating in 1990. An appeals court threw the verdict out in 1996 over a legal technicality, and rather than face a retrial, he pleaded guilty to lesser federal fraud charges in 1999, receiving a sentence of time already served. Cleaning up the broader collapse of hundreds of similar thrifts across the country cost taxpayers roughly $150 billion, well past $350 billion at today's prices, and pushed Congress to rewrite how savings institutions are regulated and insured. Cue in the rain. In September 2007, Northern Rock became the first British bank in roughly 140 years to see ordinary customers queue outside its branches to pull cash out. The bank funded long mortgages by constantly borrowing fresh short-term money from other banks rather than relying on deposits. So when credit markets froze that August over bad American mortgage debt, Chief Executive Adam Applegarth's bank found no one left willing to lend it the next round of cash. Applegarth resigned within weeks. Britain's central bank agreed to quietly lend emergency funds to buy time, but the plan leaked to the evening news before it could work, and the secrecy itself became the story. On a gray, rain-soaked morning outside a branch in Newcastle, people arrived with folding chairs and thermoses, some waiting hours to withdraw savings set aside for their grandchildren's school fees. More than £2 billion left the bank in the first few days, worth close to $3 billion today. The math behind the queue was simple and exact. Deposit protection at the time covered a saver's first £2,000 in full, but only 90% of the next $33,000, meaning anyone with real savings there stood to lose money by sitting still. The government's own partial coverage rules had handed depositors that arithmetic themselves, and they used it. Regulators eventually guaranteed deposits in full and nationalized the bank the following February, proving the math had been right all along. Sold before sunrise. Washington Mutual's own cash machine started flashing temporarily unavailable before a single teller line ever formed. Across 10 days in September 2008, in the shadow of Lehman Brothers' collapse, customers pulled billions from WAMU almost entirely online and by phone. A run with no lobby, no sidewalk, nothing a passerby could see. The bank had grown by writing riskier mortgages through the housing boom, and once home prices fell, the losses made large depositors decide to withdraw immediately rather than wait for reassurance. A single click can move a fortune in seconds. A teller's window can only move one customer at a time. Former Chief Executive Kerry Killinger, forced out by the board weeks earlier, was later sued by the FDIC, along with 2 other executives over the bank's lending decisions. The case was settled in December 2011 for roughly $65 million, most of it paid by insurance. Regulators seized Washington Mutual on the 25th of September. Its branches, deposits, and roughly $300 billion in assets, worth closer to $450 billion now, changed hands with JP Morgan Chase the same day for under $2 billion. It remains the largest failure of an insured bank in American history. The Deposit Insurance Fund itself lost nothing because JP Morgan took on the bad loans directly, while WAMU's shareholders and bondholders were left holding stock worth nothing at all. The bonds that lost value. By the end of 2022, Silicon Valley Bank held about $209 billion in assets, most of its deposits concentrated among tech startups and venture funds. During years of near-zero interest rates, the bank's leadership had parked billions of those deposits into long-term government bonds and mortgage securities, a bet that only pays off if rates stay low. The bank's own chief risk officer position sat empty for months heading into the crisis, filled again only weeks before the collapse. When the Federal Reserve then raised rates at the fastest pace in decades, the market value of those long-term bonds fell hard, the way a fixed-rate 10-year loan starts looking like a bad deal the moment new loans pay far more. On March 8, 2023, the bank announced a loss on bond sales and a plan to raise fresh capital. Word spread through venture capital group chats within hours, and by the next afternoon, a founder watching a transfer request spin on a loading screen learned the bank might not be able to pay it. Customers tried to withdraw $42 billion in a single day, close to $45 billion at today's prices, and roughly a quarter of everything the bank held. Regulators closed Silicon Valley Bank within 48 hours, the second largest collapse of an American bank on record. Later reviews found no single cause. Concentrated deposits, mismanaged interest rate risk, thin board oversight, and regulators slow to act all played a part. Federal officials backstopped every deposit at the bank regardless of size, and built a new lending program so other banks holding similar bonds wouldn't have to sell at a loss. Which of these bank runs would you have seen coming? Tell us below and subscribe for the next one.